We are going to continue our study of receivables. We're going to move to notes receivable today. And the difference between a note and an account receivable is that notes are much more formal and they earn interest, whereas an account receivable usually does not earn interest. So a note receivable is a formal contract like we have here on the screen. And notice certain things have to be stipulated. The principal amount, the time period, so term, how long is it going to last, so time, and then also an interest rate. So principal, time, and an interest rate, all of those have to be stated. And of course also, who's the payee and that sort of thing. So let's go to our demo problem. We have Rec Room Equipment received an $8,000 6-month 6% note. So the $8,000 is our principal, 6 months is our time, and our interest rate is 6%. And this is going to be in exchange for an unpaid balance, which if that's an unpaid balance, that's an account receivable. So for item A, they want us to record, accepting the note in exchange for the account receivable. So let's go over and do that. Here's where the note originates. So we're going to create a note receivable. A note receivable is an asset, so it's going to go up with a debit. And that was for $8,000. And then we want to remove, zero out the account receivable. So this is just an asset exchange. We're giving up one asset in exchange for another. We're giving up an account receivable in exchange for a note receivable. So now we have a note receivable of $8,000 and there's no account receivable. Account receivable has a zero balance, notes receivable $8,000. Okay, that's on November 1. 2 months later, it's the end of the accounting period. Well, 2 months have gone by, and it's a note receivable. We would have earned 2 months of interest. So, applying our formula for interest, principal times time times rate is interest. So let's apply that. Principal is $8,000. Time, 2 months. Notice I am not using 6 months. Only 2 months have gone by. So the time period that we're accruing is 2 months, even though this note is for a 6-month note. And then the interest rate was 6% annually. So I have a 6% annual interest rate. I have 2 out of 12 months. Notice I did not do 2/6 because the interest rate is an annual percentage rate, APR, annual percentage rate. So if the rate is annually, then I have to stipulate time in terms of 1 year as well to be consistent. 1 year, 1 year. So 8,000 times 2/12 times 6% is $80. And that is the amount of interest revenue that has been earned. So we need to make a journal entry at December 31st for this interest revenue. So let's go do that. So interest revenue is a credit, so let's go ahead and do our credit first. Not that Wiley Plus will let you do the credit first, I know you can't, but we can solve for it first. So interest revenue, revenues and ultimately increase retained earnings. That was for $80. We have not received this revenue, right? We haven't gotten cash yet. So since we haven't received cash yet, it's a receivable. And we're going to call it, but it's not an account. We don't really have an account. It's going to be labeled interest receivable. Interest receivable is an asset. So we have $80 of revenue earned, and so we've earned the revenue, in exchange we receive the receivable. Okay, so at the end of the first year, let's look at what we have. We have an interest receivable. So we would have both a note receivable to put on the balance sheet and an interest receivable to put on the balance sheet. So let's do that. So I'm going to leave a space here and plug down here. We have note receivable that would go on the balance sheet. It's a current asset, right? The cutoff time for a current asset is generally 1 year. and that's a balance of $8,000. I'm not setting up T accounts because there's only one entry to each of these, so that is the balance. And then also interest receivable. So because there's only one entry to both of these receivable accounts, I didn't bother with the T account. All right, so we have a note receivable of $8,000, interest receivable of $80,000. And then we also would have interest revenue that would go on the income statement of $80. Just plug that in. Okay. All right, now let's go to the next year. Now recall, this interest revenue will be closed out to retained earnings, so that gets closed at the end of the period. Okay, now let's move to the next year. In my case, it's 2014 is the second year. Now, in 2014, 4 months will go by, so that's going to be January, February, March, and April. So at the end of April, they're going to collect this note. So let's think through, what all are they collecting? So they're going to collect the $8,000 of principal, but they're also going to collect 6 months of interest. They will collect 6 months of interest. So let's calculate that 6 months. So principal is $8,000. Time is 6 out of 12 months. And the annual percentage rate is 6%. So the amount of interest collected is $240. So the total cash coming in will be $8,240. Okay, so total cash coming in will be that, $8,240. So let's go ahead and bump over and start our journal entry. So on April 30th, cash will come in of $8,240. Now, $8,000 of that is the principal on this receivable. So we're going to take, after this is all said and done, notes receivable should have a zero balance. So to get that down to zero, we will credit it to reduce it $8,000. Okay, so there was $8,000 in it, we reduced it $8,000, now it's zero. Now we also had $80 in interest receivable. So let's go back and think about this $240. 80 of that applied to last year. Last year we earned 2 months. This year we're going to earn the other 4 months of interest. So if I were to solve for that, that would be 8,000 times 6 months. How many months would that be? Only 4. So 8,000 for 4 out of 12 months, 6% is $160. And that's for the second year, 2014 in my case. So what we can see of the $240 interest over the whole 6 months, $80 was earned last year, $160 is earned this year. So let's go make our journal entry to record interest revenue for the current year. So I'm going to credit, revenue is a credit, so credit interest revenue. Ultimately, that increases retained earnings, $160. Now the other thing is that we have this interest receivable. And as I had noted earlier, that should have a zero balance when we're all said and done. So to get it there, we will credit interest receivable to zero that out. So we'll reduce interest receivable $80. So the account had $80 in it. We're just reducing it 80. Now the balance will be zero. Okay, when this is all said and done, look at what we did. We zeroed out notes receivable. We zeroed out interest receivable. and we added in another $160 of interest revenue. So total interest revenue, again, over the life of the note is $240. That's 6 months. So we had of that, 2 months was earned last year, 4 months was earned the second year. 6 months. 4 applies to this year, 2 applies to the prior year.